So that's the second thing I would say would creeps up. If it's an intellectual thing, it's fine. You have a good, healthy debate. You must encourage debate, and then decide, right? But forming opinions that a person has a particular position because of some other vested interest, that's where you start getting into issues. So that as you start succeeding, that ability to continue to maintain that internally debate and come to a common view, and then move on in life. Don't keep on revisiting. I think that essentially I call this as trust, right? Ability to challenge each other again is an important factor. So you don't lose that. You got to challenge each other and have the trust to finally move forward. So that's the second thing I would say is important.
Makes sense. Interesting. And so when entrepreneurs, typically I would say, I could be wrong, but at least 20 to 30% of startups do fail. I'm sure it's a lot more than that, but I'm being very optimistic here. So let's say 20 to 30% of startups fail. What are key takeaways that entrepreneurs can take away? I mean, how should people deal with failure? Because that is bound to happen.
That's a pet topic internally within our own team. And there is a thought, my colleague is not here, Lalita, who works with Nina there, we were just throwing ideas around, and I'm kind of rambling a little bit because it is an important point, that India, I believe, at least today, is not yet set up for to handling failure of startups or any businesses. And the social stigma attached with it to an extent, it may be very local, maybe just with your friends, or maybe with your uncles and aunts, or maybe somebody who's about to give you potential spouse, now they start backing off. All those kind of things can happen, right? So we are really not set up to handle the social stigma. Actually, from a business perspective, there is huge amount of learning you can take away from it. You should be able to take away learning that can be redeployed for the next venture. I would simply say that you should go back and restart another venture. And the idea we are throwing about between ourselves is that we would like to start, at least create an annual competition to fund only entrepreneurs who failed before. So they will pick one every year. I believe there is a P-3 fellowship which does, they will give a grant for youngsters who dropped out of college. Why not this? This, I think, is even more, I think you guys have gone, and you guys and girls have gone out and started something and failed. That's a tremendous experience that I think I would pay money for. Because a startup entrepreneur has certain expectations which you don't normally get unless you actually experience it and fail. Yeah. So the point is, I'm saying there is a serious issue of social stigma, and maybe stigma in other levels. But I think you should just get up, brush yourself up, and restart again.
Makes sense. I think it's a little harder in Indian situation, like you said, only because of the stigma, nothing else.
No,
it's just a matter
sure.
of mindset.
That's after you deal away with the social, friends, family part of it. I think from a business perspective, very coolly in companies say, this is what went wrong, this is why it went wrong, this is how I know I'm going to fix it, this is why I'm going to be better than all those, hundreds of people you're seeing every day for funding.
Makes sense.
And then we'll give you funding. So you all have to fail first to come to us.
That's a beautiful segue because the next topic goes back onto the investing part of it.
Okay.
So, okay, let me start off with a very question that comes up a lot. How do you decide which company to start? I'm not talking about industry or this thing yet. I'm just talking about if there are 3 companies in the same space or 4 companies in the same space.
Yeah.
How do you figure out which of them looks like they're more likely to succeed? Can I back this one instead of that one?
Yeah.
Traction could be similar. Track record could be similar, but.
Sure. So the primary, and of course we keep forgetting it, the primary thing that every investor is looking for is more than the traction, is actually the team, the founders, and their ability to communicate their passion, their drive levels, and their conviction that they are going to be able to pull it off. I think that's primarily what drives this whole thing. Traction is important to a point. They want to see that the business metrics are all moving in the right direction. But particularly in the kinds of businesses that you're likely to be involved in, showing that you have the of course, the business idea, the proposition, you'll get all that right? I mean, over time you will get it right, and you will have traction. And as you said, when you see traction, I think we would like to see that the team is really, passionate about this, and they have a team that is beginning to gel nicely in terms of, taking that business forward.
And when you talk about the team, two questions on that. One is it true what all the papers keep saying? You need to be IIT, IIM, otherwise funding is difficult. And second one is, do they need to have track record in that space? Or is it okay if, a techie suddenly decides, you know what, I'm going to start a medical tech startup or something like that?
Yeah, no, that's a very good point again. So which goes back, I mean, I'm going to answer this it's a practical sense. It goes back to making sure that you're picking the right businesses. So if you're going to be saying that I want to build, not the next Flipkart, but Flipkart kind of company which is going to consume whatever $4 billion, then I think increasingly signaling through prior credentials is important in those businesses, whether it's IIT, IIM, where you work, blah, 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 and so on and so forth. So which is, and anyway, those businesses capital is the primary competitive advantage. Unless you think you are very slick at raising that kind of capital, I would say tread with care. That's my personal take, and maybe to do with my personal risk preference, because the upside is also high. So the first part of it is that, tread with care on what businesses that you select. The next thing, what was the actual question? I'm sorry, I lost.
Does it make a difference if he's IIT, IIM, or is it okay if he graduates from some other?
It's perfectly fine. In fact, our most successful companies you will find are non-IITians, non-IIMs, and in fact, these will be the companies where he'll be hiring or he or she will be hiring all the IITians and IIMs to come and work for them as very middle management positions. So that's a given. I mean, you see that in the US, which is a more advanced market, where why do they say, dropout is the primary thing, right? IIT didn't make any difference, right? There was no IIT, IIM, no Harvard, whatever. Bill Gates was a dropout. Steve Jobs was a dropout. Peter Thiel was a dropout. So anyway, the point I'm trying to make is that, but the businesses but all those businesses, money was not the primary competitive advantage to build that business. When you want to rapidly raise capital, and that's the only business model of that, to become the largest market player before others come in, then I think everybody is looking for small, quick signals to say, okay, this guy is reasonable to take a bet on.
Yeah.
That's the challenge. If you go into that kind of a business, you need to have all the bells and whistles of, all these people. And if you can charm an IIT and an IIM and a McKinsey and all these persons to come and join you, then great. Otherwise, you should stay away from those businesses.
And so when we were talking about, one of the things that we were talking about earlier was on traction.
Yeah.
That's what a lot of investors, it could be angels, it could be VCs, it could be PE, anybody will say, show me traction, especially for early stage companies. Is there, so this question I get asked a lot, right? So what is traction? Is traction, I have 10 paying customers, 20, 100, 1,000, 10,000, what is it?
Sure.
Where does that number stop?
So you folks have to address this very smartly, and then, and also make this comment to these people. Once I get to that stage, you will say, no, come back when you have another higher number. So this is what you have to guard against. But the real point, as I think we addressed it a little bit earlier as well, is about not the number that you reach, but how did you reach it? And the business is we talked about, are you able to scale at a particular rate? If you have every 5 rupees you spend on marketing, can you attract X number of customers? Is that X increasing? Right? The trend is what is important. And I think you have to pointedly tell whoever you meet when you're going to be fundraising, guys, it is not the number that matters, it's the rate of change that matters. That's exactly, it's the cost of acquisition, I'm talking about internet, rapidly scalable businesses, then the cost of acquisition, the cost of delivery coming down, the consumer satisfaction going up. Be very anal about tracking those numbers. That's more important than to say, oh, I reached 400 customers, oh, next month I reached 500 customers. So the rate of change and saying I know how to manage my rate of growth and the rate of improvement in terms of cost, rate of satisfaction improvement. I think that's more important.
Okay.
If you can easily confuse us if you come with that approach. I'm telling you that way. Inside secret.
I think that's a very valuable insight that you've given us.
Just divert for the why do you want 5,000? I can get 5,000 customers after spending $20 million. What's the big deal?
Makes sense. And one more question on investing, right? Which is the valuation. Which is another question that today has become a big question mark thanks to all these big billion-dollar babies, as they're called.
Right.
A lot of them might not have logic behind the valuation. I personally think a lot of them don't.
They all have logic. There's a lot of logic.
Yeah. So I wanted to ask you: is it art or science? Is there something that people should look at? Because people come and say, "No, do I look at profit? But I'm not profitable because I'm a startup. Do I look at revenues? What do I look at?" And a company like Flipkart, every 5 months raise capital at double the previous valuation.
Correct.
It's a little harder to justify valuation for a very
No, it is all perfectly justified, and they are very smart people who are investing. Much smarter than me and Sriram here. That's why we don't fully get it, but they're all doing the right thing. But you need to understand one thing though, which is you have to read the term sheet and the investment agreement that is attached to that investment. And that's where the rub lies. I mean, you never get to see it, I never get to see it, and Sriram doesn't get to see it. And the newspapers also don't get it. The terms will show you that the valuation is moved from 5 billion to 15 billion in one shot, but it will also tell you, and they raised $1 billion. It will also tell you that the person who's put in, or the groups who put in the $1 billion will get their money out first, as and when there's an exit. They will also get not just their money out, they'll get 2 or 3 times their money first, and then they will still have their shareholding as a pro rata sitting in it. It's a simple structure called participating preferred structure. Just one example. So when you say, am I willing to give somebody $15 billion in one shot? I'll give them, no problem. But you give me my 5 times my money in first out, then whoever is left, you get to share it.
Whatever the rest.
Right.
Oh, okay.
So the idea though, the lesson from that though is don't get caught up in the valuation. It's being done at the right reason for the smart people, and everybody is making the right choices, including the entrepreneur. Not that entrepreneur has gone for a ride there or the previous investors have gone for a ride. They also know that they're also taking a bet that we're going to actually increase the value so much, right? So the point I'm trying to make is don't get carried away by valuation unless you understand the terms. So the terms are more, it's a total package. Otherwise you confuse yourself. Here I would say use adult guidance here. Adult supervision is very important in such matters. So not that you're not adults, I'm just using that term very loosely.
And when you're talking about valuation for early stage, right, companies who are still yet to, probably Series A or pre-Series A, does it typically happen on revenues? Does it typically happen on, probably on traction numbers, on the gross merchandise value, whatever it is? Because that's something that I'm sure a lot of them are going to be asking you in the Q&A after this. So I'm trying to preempt that.
Say that again.
So valuation.
Maybe I'm getting tired. I want to get Hari in here. Can we bring Hari here?
Sure.
Come, Hari, please.
You want to join?
Yeah, you use this. I can speak without a mic. Come.
Yeah, before I get started, I'll give you a little bit of my introduction, and I have experience both on the private and the public side. I graduated here in '87, and
so 11, 12 years after me. I couldn't get to rag him, but
I worked in management consulting for a while, did my MBA. Then I actually started my own firm. This was in late '99. This is when the B2B commerce was very hot. I was actually PricewaterhouseCoopers running the supply chain practice, and after refusing 5 or 6 offers, decided finally to jump the ship, but it turned out to be a wrong decision. It was too late in the game. But there are a couple of parameters that I would kind of advise you from an entrepreneur perspective on what you should look for. Obviously, my firm failed, and through my venture capital guys, I got introduced to Wall Street. I first started off as a sell-side analyst covering that industry, and in 2005, I joined Lehman Brothers on the buy side, or to run their technology side of the equation. So I covered software, internet, and IT services on a global basis. Lehman Brothers, as you obviously know, in 2008 declared bankruptcy. The asset management portion of Lehman Brothers got converted into a company called Neuberger Berman. and the employees actually bought the company, and I'm a partner in the company. Right now, we are about we have $250 million under management. Part of it is institutional, part of it is high net worth, part of it is retail mutual funds. And I handle their investments on the three subsectors of technology: internet, IT services, and software on a global basis.